At the age of 33, Dan Loeb was ready to start his own hedge fund. The trouble is, he only had $300,000, barely enough to cover business fees. Loeb turned to his family for help. Trusting his abilities, his family and friends invested $3 million with him. This is the beginning of Third Point, one of the best performing hedge funds in America. Dan Loeb was born in Santa Monica, California, in a well-connected family. His great-aunt was the inventor of the famous Barbie doll. Raised by greatly educated Jewish parents, it was inevitable that Loeb would receive the best education as well. After enrolling in UC Berkeley, Loeb became deeply interested in finance. But he wanted to be close to the action, and there's only one place to go. After 2 years at UC Berkeley, he transferred to Columbia University in New York. At Columbia, Loeb started trading stocks in his dorm room, eventually making him $120,000 in profit. But before he could celebrate, he lost it all in one bad trade. Losing that large amount of money in the 80s really had a big impact on Dan Loeb. He realized he cannot trade the stock market like a casino. There must be some kind of investing methods that generate consistent returns. After graduation, he became an analyst at a private equity fund, Warburg Pincus, for several years. The private equity business allowed Dan Loeb to learn the critical skills of business analysis and valuation.
I worked at Warburg Pincus in private equity. But my real passion was always the stock market. I worked at a firm called Lafer Equity Investors in risk arbitrage and learned that craft.
A few years later, he switched job to become a bond trader.
My real trajectory took off when I started on the sell side at a firm called Jefferies in 1991 at the beginnings of the distressed debt market.
The career Dan Loeb had was lucrative, making him over 6 figures a year while in his late 20s. But he wanted much more. He knew he could only get there by starting his own fund.
I used to just fantasize about starting my fund and how I would name it: Third Point Capital, Third Point Management, Third Point Investing. Then I'd scratch it out. I'd do logos. This was really a dream of mine to get this thing going.
In 1995, he made his biggest leap and launched Third Point with $3.3 million of capital.
I luckily had a good friend of mine who was a wealthy individual who promised to give me about $1.4 million. I didn't have a wealthy family, but at least they were in a position, parents, aunts, a few other people gave me a couple $100,000 each. So that was really the start of Third Point.
After making 8% return in the first month of trading, Dan Loeb was confident that he made the right decision. And he soon came to understand that in order to make a name for himself in the hedge fund world, he had to perform well, both in the bear and the bull market, which means producing absolute returns. To accomplish that, he must find a unique trading strategy. To create returns that are uncorrelated to the market, he decided to pursue an event-driven strategy.
We're an event-driven shop, so a lot of what we're doing is risk arbitrage, credit plays, things like that. So I wouldn't say market neutral, but we're a little less sensitive.
Typically, certain corporate events can cause short-term volatility in asset price. Events such as corporate reorganization, restructuring, merger, acquisition, and bankruptcy. Event-driven investors are experts in analyzing these special situations and making use of the mispricing opportunities. In his first 7 years, Third Point had made steady double-digit returns by taking advantage of short-term undervalued opportunities.
My time frame that I look at from an investment portfolio, from an investment perspective, is more like 1 or 2 years.
Soon, his stellar returns have caught the attention of large hedge fund investors. Dan Loeb was ready to join the big league. As Loeb kept creating serious profits, more investors invested. Third Point quickly grew to have over $100 million by the end of 1999. As the size of Third Point grows, so is the pressure to find more opportunities. When your fund is small, you can be more nimble and your actions don't create a lot of attention. Dan Loeb soon discovered there was money to be made in short selling, finding both value plays and shorting fads and fraudulent companies. And not before long, he found himself in the dawn of a major crisis. Driven by investments in internet-based companies, between 1995 and 2000, the Nasdaq market index rose 400%. It reached a price-earning ratio of 200, while the average PE ratio for the stock market has historically been about 15. Dan Loeb knows this is his time to shine, so he shorted the entire tech sector.
I never participated in the craziness of the internet bubble, but I missed the crash. In fact, I profited from the crash because at a certain point when I thought things were really breaking, we started to short stocks and did very well. And that really set the stage for Third Point to raise a lot of capital, because when they saw that we made money when the market was falling apart, then we attracted a lot of capital.
By the end of 2000, he beat the market by 26.2%. Over the next few years, Third Point consistently beat the market as the fund grew bigger than ever. Coming in 2007, Third Point was going strong. Date Bearing was a company that manufactures testing machinery, supplies for the medical diagnostics industry. In 2003, the company was in financial distress. As a result, its bond price was trading significantly below face value. Dan Loeb took a bet on this company, believing that the business will recover soon. And just as predicted, the company did come back, making Third Point 600% profit in its investment. But little did Loeb know, in just a few months, the biggest financial storm would bring him to his knees. The financial crisis brought on the worst year in Third Point's history. In September, just before Lehman Brothers collapsed, Third Point had about $5 billion under management, with earnings up 4% for the year. It ended the year down 30%.
It was a mess. I just thought, God, I spent 13 years building this business, and I felt like it was just slipping between my fingers. The organization was demoralized. I had huge overhead. Then the redemptions started coming in, so we lost, a third of our capital, about $1.4 billion in redemptions at the end of the year. So I thought, well, at least I have my health.
Dan Loeb quickly discovered, although the market was in turmoil, it also presented him with a lot of opportunities, the ones his fund was most equipped to exploit.
February came along, and we felt really good again. We were up 4%, the market was down 25%, we made all these smart defensive bets, we did what we're supposed to do, we protected our capital during a tough time.
By mid-2009, there was still a lot of uncertainties in the market.
Well, I don't see how anything's changed, to be honest. We still have the same problems that we had before.
But Loeb was more bullish than ever. He felt strongly that the market should only go up from here.
The turning point for me was Citigroup Pref Common exchange deal. Citigroup has hundreds of billions of dollars of liabilities. It was insolvent for all intents and purposes, but they did an interesting transaction where they exchanged preferred stock, which is at the bottom of the capital structure, into equity. They also got a lot of government goodies guaranteeing things, but it gave them the capital that, combined with their own earnings power, made Citigroup a financially viable entity going forward.
He started actively buying bank debts. 8 months later, at the end of 2009, Third Point was up 45%. Third Point survived. By 2021, Dan Loeb has a net worth of $3.5 billion, and he's not hesitant to spend like a billionaire. Like many hedge fund billionaires, he made most of his money from the fees he charged by maintaining an above-average returns. Over the years, Dan Loeb had indeed created above-average performance consistently, including over 20% profit for 2020. An event-driven strategy is only applicable to those with deep knowledge on how certain companies and industries work. It is also inherently speculative.
I was lucky to start it when I did, with the focus that I had, was looking at parts of the market, distressed debt, special situations like spin-offs, demutualizations, post-reorg bankruptcies, during a period where that was a good strategy to be in.
Now with a large amount of capital at his disposal, Dan Loeb has made a name for himself as an activist investor, taking stakes in many well-known brands such as Yahoo and Nestle. A lot of these hedge funds are pursuing what's called alpha, the returns above the market. To do that, you have to have an edge, either with unique information or some kind of intervention to the company that create more value. Over the years, Dan Loeb has gone through many bull and bear markets. While a great majority of hedge funds have died out, third point has prevailed.